If you're feeling a bit uneasy about investing lately, you're definitely not alone. The current economic environment is shifting rapidly, and it's natural to wonder how to navigate these ups and downs. Today, we're going to examine a well known piece of advice from the famous investor Warren Buffett. Be greedy when others are fearful, and fearful when others are greedy. This might seem like it goes against common sense, but understanding this idea is really important, especially when the market is changing a lot. We're going to explore this concept by looking at some of the biggest stock market crashes in history and figuring out what happened and what we can learn from them now. To really get a feel for how to handle markets when things are uncertain, studying history can be super helpful. The reasons why the economy sometimes has problems might be different each time, but the way the market usually drops a lot and then bounces back is a pattern we see over and over. So let's check out three important examples of this. Our first stop is 1929 and the Great Depression. Before we talk about that, it's important to know that some things had been changing in the world of business. For example, companies had started to form corporate trusts. These trusts were supposed to help businesses grow, but they also made it easier for people to take big risks with their money. So by the 1920s, there was a lot of speculation, meaning people were making risky investments, hoping to get rich quick. This set the stage for the big crash that was about to happen. And when the crash finally happened, the statistics were alarming. The stock market, measured at the time by the Dow Jones Industrial Index, experienced a massive drop, losing approximately 89% of its value between 1929 and 1932. On the first day of the crash, Black Tuesday, the market fell almost 12% in a single day. This was a decline unlike anything people had ever seen before. Now, afterwards, things didn't improve quickly. It actually took a surprisingly long time, 25 years, for the market to recover to its pre-crash level. The government tried to help through the New Deal, which included programs like the Emergency Banking Act. And one of the main problems was that many banks had failed, and people were afraid to put their money in there. The Emergency Banking Act helped to fix this by giving the government more power to oversee the banks and making sure that banks had enough money to cover people's deposits. This helped people regain trust in the banks, knowing that their money was safer. Still, the effects of the crash and the hard times that followed lasted for a really long time. Now, let's jump ahead to October 1987, the day everyone calls Black Monday. Some people noticed that before the crash, the cost of things wasn't going up as fast as it used to. Because of that, some people thought the market was going to drop soon. The stock market, as measured by the Dow Jones, had reached its highest point at 2722 in August of that year. Then disaster struck. On Black Monday, the Dow Jones plummeted in a single day, dropping more than 500 points, which was about 18.6%. It closed at 1738, and some reports pointed out that this drop was even more severe than the drop during the famous 1929 crash. All around the world, the losses were huge, totaling about $1.7 trillion. Now, some speculate that given the circumstances, the market could have fallen even further. And what's surprising is how much faster the market bounced back this time. While things were extremely chaotic in the immediate aftermath, with frantic buying and selling, the market began to recover relatively soon after the crash. Some people speculated that the lowest point was reached either on that very day or the next. And indeed, the stock market was back to its pre-crash level within 2 years by September 1989. The Federal Reserve, which acts as the government's central bank, urged banks to loan money to market makers, which likely contributed to the stabilizing of the situation. Now, some financial experts believed that the most intense selling occurred on that Monday and anticipated government intervention to help the market. Now, the most recent example is the stock market crash of March 2020, which happened because of the COVID-19 pandemic. It spread so quickly around the world, and as news about the virus got worse, investors started to panic, worried about how shutdowns and travel bans would hurt the businesses and the economy. In just 6 days, the stock market dropped 10% from its highest point ever, making it the fastest correction in history. Now, the Dow Jones and other major indexes kept falling, with some of the biggest one-day point drops ever recorded. This sudden crash was made even worse by people rushing to sell their stocks and computer programs that automatically sold shares when prices started dropping. The uncertainty and fear around the pandemic caused markets all over the world to fall sharply, and it took a while for things to settle down again. Between February 20th and March 9th of 2020, the Dow Jones went through a series of major drops. One day it fell by 1,190 points, which was about 4.4%, one of the biggest single-day losses ever. The declines kept coming, and soon the market had dropped 20% from its recent high, which means it had officially entered what's called bear territory. Many people compared the huge amount of selling and the panic during these days to what happened during the 1987 crash. Since both times saw record-breaking numbers of trades and a lot of fear in the market. This crash saw another surprisingly quick bounce back. By April, the stock markets around the world had already started rising again, officially entering a bull market. The Nasdaq reached a new high by June, the S&P 500 followed in August, and the Dow caught up by November. A big reason for this fast recovery was the help from the Federal Reserve and the government who stepped in with emergency programs and stimulus money. Even Jay Powell, the head of the Federal Reserve, said he expected the recovery to take a long time, but even he was surprised at how fast things turned around. So what should we take away from looking back at these big market crashes? The first thing is to remember that market crashes, even though they can be frightening and shake things up, are actually a normal part of how the economy works. Over and over again, history shows us that markets usually bounce back, even if it sometimes takes a while. The main lesson is that while downturns can be tough in the moment, staying patient and sticking to your plan can pay off in the long run as the market recovers. Now, this brings us back to Warren Buffett's famous advice: be greedy when others are fearful. When the market takes a big hit, fear often pushes prices way down. For investors who can stay calm and think long term, this can create a chance to buy valuable stocks at a discount. Paul Tudor Jones, a well-known investor, pointed out after the 1987 crash that there's often a rally once the worst of the selling is over. But he also warned not to rush in all at once. Instead, he suggested easing in slowly. Other investors share similar views, reminding us that while market crashes can feel terrifying, it's important to not panic and sell at the bottom. Buffett also recommends keeping some extra cash on hand, so you're ready to invest when good opportunities come up. It's really important to keep in mind that the stock market is unpredictable, and just because something worked in the past doesn't mean it will work the same in the future. No one can say for sure what will happen next, but when the market is uncertain, it's actually a great chance to learn. These moments push us to think about how much risk we're comfortable with, to really understand companies we're investing in, something Warren Buffett calls staying within your circle of competence, and to make decisions based on facts instead of emotions. Buffett also reminds us not to just look for the cheapest stocks, but to focus on finding high quality businesses to invest in. Warren Buffett has been holding on to a lot of cash, and people see this as a sign that he's being careful. Now, we don't know exactly why he's doing it, but if we look at his past decisions, Buffett usually keeps cash ready so he can buy great companies when their prices drop because people are scared. Now, I hope this journey through history has given you some useful context and help you feel more confident about handling the ups and downs in the market. And if you found these insights helpful, make sure to follow the channel for more practical tips and strategies on investing and building long-term wealth. But here's the main thing to remember. History teaches us that market downturns are just part of the normal cycle. Even though they can feel stressful in the moment, they also create opportunities for investors who stay patient and stick to their plan. Keep learning, know how much risk you're comfortable with, and focus on building a portfolio filled with strong, reliable investments. Thanks for watching, and if you're interested in learning more, check out this video on how to take the next step in your financial journey.